What is going on, family? It is your boy, Lowedaddy, Lowstradamus, Lowrided, the Dollar Store TC, whichever way you want to chop it up. Whether you like me, whether you don't like me, somehow you can't get rid of me because I'm back again with another video trying to tell you guys how to use this den of due diligence put together for you. If you want to know how to get to this screen that you see right there, I will try to put a link right here if I can figure it out on this YouTube machine we've got, and the video I put together already for y'all on how to even get to this far. Where to go? You can see the URL you need to go to. It's growsaloon.com/growth-resources. Make an account. I don't think any of y'all are looking for marketing services, so I'm not going to be spamming you with emails and whatnot. Don't worry about that. And it's for my favorite price, free 99. Not forever, but if you sign up now, it is forever. So go ahead, take 5 minutes to watch that video and get to this point, and then you can come back here and you can watch what I'm about to show you. This is going to be for the public companies portion. So there's a lot of lingo in here. There's a lot of numbers. It can be overwhelming. I'm going to do a quick breakdown on how to decipher and interpret all the numbers you see in here. So I'm going to start by, just going to den of due diligence, public companies. I'll do the same thing for SPACs later on. And then I'll go more in depth with these numbers, for certain ratios, what you want to look for, how to break down a balance sheet, how to break down, statement of operations, income statement, in other videos in the future, just to help you out a little bit more. But this is going to be just a quick breakdown of what to look for here and how to decipher everything you see here. Like I said, there's a lot of numbers. There's even more when we get into it. When you get this far, you can sort it by any of these columns you see here. So if you click on ticker, it'll sort it alphabetically. You want to sort it by company name, do that, sector, industry, anything here, you can sort it by that. So just click on it, you can play around with it a little bit, but let's dive into it. So if you look at this, let's start with just Airbnb. That's one I added today during the stream. Someone said they were very interested in it, or their wife was, or whoever. I looked at their 10K, that's their annual report, and this is what we found. So I'll kind of walk you through what you're looking for here, right? You can see obviously too, really quick before we really dive into it, the current as of. Now, all of these, they've got codes in the sheet that this imports from to basically import these or update these prices every 20 minutes. So it'll always give you the current stock price, the last close price, the current market cap around this price you see here, and then these numbers will adjust accordingly as well. And we'll get into what those numbers are in a second. So if you sort it by this, though, you'll see that there are certain ones that don't pull that kind of information because Google's just not updating it that often, so these numbers have to get pulled manually, and I don't really care to update Joann Fabrics that often, unfortunately. So I'm sorry if you're a Joann Fabrics shareholder, but like I said, let's dive into Airbnb first. That'll give you an idea as to what you're looking for here, and we'll walk through everything. So sector, industry, this is straight from Google. It's a vacation rental company, right? Pretty self-explanatory. Current as of today. $190 what the current share price is. It closed on the 5th yesterday at 186.69. The market cap at 190.03 is about 113, almost 114 billion dollars. We'll worry about these numbers in a second because we need to go through the balance sheet information. We need to go through the statement of operations information to give us these numbers as well. So let's move on to total assets. This is going to be for their 2020 annual. You're looking at almost $5 billion in total assets they have in their bank account, you can call it, between everything they've got, property, that's cash and cash equivalents, that's accounts receivable, that's literally everything. I'll show you on their report in a second. I'll pull it up for you, where we get those numbers from and what you're looking for, so you can start to break down these reports the same way. And like I said, I'll make videos that go further in depth, but I want to do just a quick run through so you understand what you're looking for on these sheets. This is their 2019 asset total. So at the end of 2019, they had 8.3 billion. They went public in 2019 or 2020, so it makes sense that they're up about $2 billion. You want this number to be in the positive. If you want to see all the information for any given company, click this plus icon right here. You're going to see there's way more than what you see. So that's going to open up a whole can of worms for you. You're looking at total liabilities for 2020. This is all of their debt. This is everything they got to pay for. This is their accounts payable, who they owe money to. This is all in there, and that's going to be found on their balance sheet as well. So you're looking at $7.5 billion, almost $7.6 billion in 2020 is what their liabilities have gone up to. And then in 2019, it was at 5.8, almost $5.9 billion. So it's an increase of 1.7. But as they had their public offering and they had all of this cash added to their balance sheet as far as assets go, you want them to take that cash and you want them to apply that to uh, growth operations, things that are going to grow the company and take them from hopefully $113 billion market cap to a $200 billion market cap, because that's what makes your money go up. You need that market cap to rise, and your share price will rise along with it, or the value of your shares, if there's a split or anything, is going to rise with it. So this is to be expected. Like I said, this debt to asset ratio, all you're doing is you're taking your total liabilities and you're dividing it by your total assets. And that gives us 0.72. So what you're looking for there in debt to asset is anything above zero point 0.5. It means that the company is financed primarily off of debt. So they're taking on like I said, just more debt, so that their accounts payable is going to be up. They're going to be buying more equipment. They're going to be buying more property. They're going to be paying for a lot of stuff to enhance the growth of their company. So, like I said, that's to be expected here. But anything above 0.5, it means it's financed mostly on debt. So the higher this number is, if it goes above 1, the company is insolvent, and you don't want anything to do with that company, because if the market goes kaput tomorrow, debt collectors come calling. This company's history, it's going to go belly up, or they're going to have more offerings that dilute your shares, and probably look for some restructuring opportunities. So, but the closer this is to 1, the more risky of a play it's seen as, right? Or if it's below zero point 0.5, it means that the company is financed mainly on shareholder equity, and so you'll see that below here. And all you need to do to decipher what that means is just know that a balance sheet is always going to equal your assets, and they're going to be weighed evenly, so it's always going to even out with total liabilities plus total stockholder equity or total shareholder equity. They're synonymous. That's always going to come even. So sometimes if the company is insolvent, you'll see that the shareholder equity is actually, or stockholder equity is at a deficit. You don't want that. That means your shares are worthless on paper, right? We'll get into that in a second, but the lower your liabilities are, the lower this ratio is. If it's 0.2, it means that on paper, our equity is worth more per share. And like I said, we'll dive into that again later. But we want this to be below 1 for sure. We want it to be below 0.5. It's going to be considered a safer investment. When you play the stock market, anything can happen. We try not to gamble here. We are value investing. I am the only 25-year-old value investor in the world, and even I break my principles sometimes too if I found a really good company. But yeah, we want this to be below 0.5 for safe investments, but we're not against investments if it's above 0.5. We just got to make sure we like the rest of what we see. Now, here for current ratio, you're looking at your current assets and your current liabilities. And so when you're breaking down a balance sheet, you're going to be looking at everything is going to be ranked in terms of liquidity. So you're going to see number 1 for current assets, cash and cash equivalents. That's always your most liquid asset. Think about it like yourself. If you want to buy anything, if you want to go to the store and you got cash, that's liquid, baby. You can hop on an opportunity right now, right this second. Now, what you see beyond that, maybe you'll see securities on some people's balance sheets. So like, let's say you have assets of your own that are in stocks. If you've ever transferred brokers, if you've ever needed to, make some of that money liquid for rent or whatever your use case is, it takes 3 to 7 business days for that money to hit your bank account finally, depending on the broker. Now they're trying to speed it up and whatever, but it's just ranked in terms of how quickly these assets can become liquid, and anything that can be liquidated in a year or less is considered a current asset. Same goes for current liabilities. Those are things that are going to be due the soonest. Things that are due in a year or less is a current liability. So you want this number right here to be above, at the very least, a 1.2. That's considered healthy liquidity levels. Now, the newer a company is, and the less they have asset-wise, like, Airbnb is not a new company. They just IPO'd, so that's, I guess, a unique case, but a lot of the SPACs, and we can get into those as well. You want this number to be, for sure above a 2, above a 3, even better. The higher this number goes, the better it is. And some investors will say, if the number gets too high, and this is where it becomes subjective, we're trying to be objective based here, but some investors will say, if that number is in the 20s or in the 30s, they're too liquid. So it's healthy liquidity. They could hop on opportunity right away. You want that. But if the number is, say, in the 20s or 30s, some investors will say that they don't know how to use their money properly. They're not growing the company. My money is not going to grow because of that. They want that number to be lower. I'm not like that. The higher the number is, all I care is that they have liquidity. So yeah, this is so you can hop on opportunity. Like I said, I'll give you a more thorough breakdown in another video if y'all want. But yeah, they're healthy. This is Airbnb. They got 10 billion in assets. They got almost 9 billion in current assets. They've got 5 billion in current liabilities. 1.73 is more than healthy. They got $3 billion to hop on opportunities with. So we're good there. Now, when you're looking at total stockholder equity, like I said, assets equal liabilities plus stockholder equity. So the lower our the lower our liabilities are, the higher our stockholder equity will be. And what you want is this number right here, the difference, the plus minus between 2020 and 2019, or if it's Q4 versus Q3 or whatever the case is, you want this number to be going up. If it's going up, it means your shares are worth more money, which is a good thing. If they liquidated the company tomorrow, our shares are worth about $3 billion, and that's going to be divided by the number of outstanding shares, which we'll see below. Now, what you also want to look out for is preferred stockholder equity. This is things like dividends or just preferred shareholders in general. They get paid first before we do. Now, most public companies, you'll see a big zero there unless they pay dividends. Then you're not going to see a zero there. I'll show you in a minute why that matters. Outstanding shares, you can see this. And before we move on to the revenue and whatnot, from the statement of operations or income statement, they're synonymous. I'll show you how we get these values above as well, other things you want to look out for. So your book value per share. I've got the formula right here for you if you forget it. You're looking at your total shareholder equity, so the number we mentioned below, subtract the preferred shareholder equity, so that would be things like dividends and whatnot. It'll specify it on the balance sheet. And then you're going to take that outcome and divide it by the number of outstanding shares. Makes sense, right? What our shares are worth on paper divided by outstanding shares gives us a book value of $24.02 per share. Now, we use this to find my favorite ratio, the P to B ratio, price to book ratio. So you find that by taking your current stock price right here. I said this always updates automatically, and you're going to divide that by your book value per share, which is found right here. This will be updated whenever they have a new filing, and I'm trying to keep these separate as well. So I'll do Airbnb's Q1 in a whole separate row for you. I'll do, basically every report they have from now on, I'll do in a separate row. So we're looking for anything below a 1.0 is considered to be definitely undervalued. Our book value per share outweighs what the market is telling us our shares are worth, even though we know that our assets are, far outweighing that. We know that our equity on paper is worth more than that. So not to say every company like that's going to go up, but it gives you high confidence. If you find a good company, you're getting a great deal on it, right? That's what value investing is all about. 4K TVs suddenly get super hot. I don't want to go pay $5,000 because everyone wants a 4K TV right now. I'm just going to wait till the crowd calms down and I can get a fair price because I think 4K TV is a great product. I'd rather spend $500 on it because I know that's what they typically go for if the market wasn't going crazy for 4K TVs right now. That's all value investing is. So I don't want to pay 8 times what my shares are worth on paper. I'd rather pay a multiple of 1 or less or 3 or less. That's typically what I'm looking for, and that's where it gets subjective. So yeah, that's why we want to know outstanding shares. That's why shareholder equity is important to know. You can see right here, reporting period. This is their 2020 annual report, their 10K, released in February. And then you can scroll down here. You'll see a link to the report. Click on that, opens up everything that I've taken the time to go through for y'all, get the numbers from. As you can see in this report, we've got about 130 pages. So if you don't want to go through this, that's what I've got this sheet together for you. For y'all for, is to avoid having to waste your time doing what I like to do in my free time, because I don't do this for a living, guys. I'm an online marketer. I'm not a financial advisor, so everything you see here is self-taught. I just find it fascinating. I like numbers. Anyway, back to the reports. So this is their 2020 annual report. You can see that their revenue for their current period, and this is maybe Airbnb isn't a good example for this because they don't have it separate. Sometimes we're lucky. Their annual reports are the best thing you can get because it shows you their whole year in review versus the whole previous year in review. Some annual reports will have like their full year. That's why it says current period. And then it'll have full year, and then it'll have like their Q4s. And I could show you one really quick as well. below this, but for the sake of brevity, let's just trek along here. I think this video is getting decently long already. But yeah, you're looking at their current revenue for 2020. But this is Airbnb. It's expected to be down, right? Vacations are pretty much shut down for the most part everywhere in the world. No one's staying in Airbnbs. They're making a lot of good moves as a company that I, saw on the news or read about, which is nice. But their revenue is down by $1.4 billion. So not a great year for Airbnb. And then you're looking at their income or their net income. They already weren't profitable, even though they were making $4.8 billion in 2019. Look at their net income. Revenue, top line, net income, bottom line. After everything's paid for, this is what we're left with. That's what we care about. You'll see that reflected in the profit margin below as well. But they brought in $4.8 billion in 2019. And in 2019, they lost at the end of the day almost $700,000. I'm sorry, almost $700 million. So they weren't profitable then. You're hoping to see in this report that their profit margin is increasing. That's what you see down here. They were at negative 14%, but then in 2020, we can see up here that they brought in 3.3, almost 3.4 billion, or yep, $3.4 billion in revenue. And then at the end of the day, they were left with negative 4.5, almost $4.6 billion for net income. Not great if you're an Airbnb shareholder. So their profit margin did not increase from negative 14 closer to zero or above zero like we had hoped. It went to negative 135, almost negative 136%. Not great. So look out in Q1, see if that profit margin is inching closer, back to their old number at the very least if you like Airbnb. But that's what these numbers are for, so y'all can make your own opinions on it. I'm not going to influence any investing decision. You should never take anything I say as factual. It is all opinion based, and like I said, I'm not qualified to give you investment advice. I'm not a financial advisor. My father's a financial advisor, but that doesn't help us at all here. So yes, you're looking for the profit margin to increase though, and that's what you're seeing here between the revenue and their net income. You want to be profitable, which is what these numbers tell you, and you want the revenue to be increasing every quarter and every year as well. If you're a shareholder, that's what increases your earnings, and that's what helps your share price rise in value. Good earnings reports. So yeah, like I said, you can click on this link. You can go through the whole report yourself. If you go through, let me see if I can just skip to the okay, I think it's 78 is what I gotta go to. Click on that, and this should give us our balance statement. Oh, it will in a second. Yeah, okay. So yeah, you can see this is their balance statement. You're gonna want to look up here when you're ever breaking these down. Like I'll make a whole video on this for y'all. Again, I wanted to keep this as brief as possible, but this is in thousands. So you're going to add 3 zeros at the end of all these numbers you see here. Some of these are in millions. So you'll add 6 zeros at the end, and you got to make sure that this is in USD. If it's not in USD, you need to convert every number. I've got many of those companies in my den of due diligence. Let me tell you, it's a pain in the ass to convert all of those. But if y'all like it, you won't have any trouble doing it. That's the balance sheet. That's where we get all those numbers from. This is their statement of operations or income statement. These are in thousands also, so add 3 zeros at the end, except for per share amounts. So these numbers down here, don't add 3 zeros at the end there. But yeah, revenue top line, net income or net loss, bottom line. They lost all that money. Back to this, last thing you're going to see is just additional notes. Those are notes that I take, kind of summing up what I see up here on some of them. Their revenue decreased in 2020, but we were expecting that. Net income decreased in 2020. Not great to see that. Profit margin decreased in 2020 from this to that. Not great. Book value per share is this, giving us a PB ratio of this. Not great value there. I think it could already be priced or fully priced. That's what you're going to here when you're value investing, is that a company is fully priced or it's just overvalued in general. There's a lot of companies out there like that right now, with a lot of speculative growth priced in there. So a company I just did where I had to convert all the numbers, for example, is Huya. This is one where I did their annual and they have their Q4 in there also. So you can see it's their 2020 annual, but their Q4 they did almost $500 million or $500 million in revenue, up by almost 100 million from the previous year. And then for the full year long revenue, we did over over $1 billion. Sorry, it's late, folks. $1.6 billion versus the previous year we did $1.25 billion. So we're up. We're heading in the right direction. Huya checks a lot of my boxes. Pretty solid company. They're like China's Twitch, from my understanding. I'm not invested in them, so I was doing this for a buddy. But yeah, you can click on that. You can read their reports there. You can see all my notes, and you can do this for any single company I have on here. If you have any companies that you want to request, throw them in the comments below. If this video is helpful, please comment in the comment section below. Let me know it was helpful. Let me know you want to know more about this, that, whatever. I'm a man of the people. Whenever I have time, I make videos, so I will definitely make some guides for y'all to help better understand everything you see on here. I'll also be putting together a video on the SPAC section, like I said. When you go back here to the main growth resources section, SPACs, OTCs you can click on. I don't really like OTCs, so there's not much in there. Sorry. But yeah, SPACs you can click on. I'll make a video around that and how the numbers differ and what you're looking for there, along with the links that are associated with all of those tabs. But if you found this video helpful at all, please, please, please smash that like button, smash that subscribe button, and ring the little bell so that you get notified every time I drop a new video, every time I go live, and we're making money up in here, which is every single day the stock market's open, folks. That being said, y'all have a great rest of your day, a great rest of your night, whatever time you're watching that. Have a great time in general, and I will see y'all next time. Thanks so much. Lowedaddy out.